Good afternoon, everybody. This is Andy Umbach. I'm a wealth advisor here at Pulse Financial Services. And thank you for joining us today to learn more about the economic and market update for the first quarter of 2025. So happy New Year, everybody. Welcome to the economic and market update. And certainly, despite uncertainty stemming from the U.S. election, shifting monetary policy, and heightened geopolitical risks, 2024 proved to be an impressive year for the economy and financial markets. The U.S. economy was quite resilient, supported by a steadfast consumer. At the same time, inflation continued to drift lower, although downward momentum has faded in recent months, while the labor market appears to have settled into a healthy place. As the new administration takes office in January, investors will be closely watching for more details regarding policy plans and their potential impacts on the broader economic conditions. With inflation moderating and the labor market normalizing, the Federal Reserve's cutting rate cycle is well underway. That said, the outlook for 2025 is largely uncertain. Policies proposed by the incoming administration, should they provide an inflationary impulse, could result in a more gradual pace of policy easing or an early end to the rate cutting cycle altogether. Still, markets have largely taken this uncertainty in stride. Stocks finished the year up over 20% higher on the back end of broadening earnings growth and the AI tailwinds. Bonds modestly rebounded after a bumpy start, although interest rate volatility has been elevated since the Federal Reserve's initial rate cut in September. With U.S. equities trading at over 22 times their forward earnings and credit spreads historically tight, elevated valuations remain a risk. However, a relatively benign economic environment in 2025 should offer investors plenty of opportunity to deploy capital. Those who do so actively and with a keen focus on diversification should be prepared for any shocks that arise. The Guide to the Markets, now in its 21st year, is built to illustrate economic fundamentals and investment opportunities and risks. However, it's important to do so concisely, and there are over 60 pages in this guide, which is far too many for any type of productive conversation on the markets. So what we do here is boil it down to just like 12 slides. In particular, we assess the recent performance of the markets and economy, considering trends in growth, jobs and inflation, and how policies proposed by the incoming administration could impact the path forward. This is followed by comments on monetary policy, and finally, a discussion of the global opportunity set across stocks, bonds, and alternative asset classes. Twenty 2024 was another impressive year for the U.S. economy, with real GDP growing at above trend pace for a fourth consecutive year. To understand why economic activity has been so resilient and where it is headed, we can analyze its different components. Page 17 of the guide offers a closer look at the key drivers behind recent GDP growth. Given that consumption accounts for almost 70% of the U.S. economy, it's no surprise that the health of the economy is closely tied to that of the consumer. Supported by impressive gains in household wealth and 20 consecutive months of positive year-over-year real wage gains, consumer spending has powered the economy forward, contributing 2.4 percentage points to the 2.8% increase in real GDP in the third quarter. Other segments have also performed well. Despite higher borrowing costs, business investment has been buoyed by strong corporate balance sheets and fiscal support, while government spending has looked solid. On the other hand, home building has remained subdued due to elevated mortgage rates, and the combination of a strong dollar and sluggish global economic activity has weighed on U.S. trade balance. Policy uncertainty is casting a fog on the economic outlook for 2025. Severe restrictions on immigration and aggressive tariff policies, should the incoming administration implement them, could boost inflation as well as could a full extension of the Tax Cuts and Jobs Act if supplemented by further extensive tax cuts promised by the campaign trail. Still, none of these policies appear to portend immediate recession, and an activity and interest rate sensitivity sectors normalizes and consumer spending settles at a more moderate pace. 2025 should be another year of expansion, likely at a trend, pace for the U.S. economy. After rising during the first half of 2024, the unemployment rate has stabilized at 4.2% in November. Unemployment is meaningfully above its cycle low of 3.4% set in April of 2023. That said, it is still lower than it has been almost 88% of the time over the last 50 years. In 2025, steady economic growth should support continued job gains, reducing the risk of any further meaningful rise in unemployment. In fact, should labor force growth slow due to more restrictive immigration policies, unemployment might even drift lower over the course of the next year. With stable unemployment, wage growth should stabilize also. Loosening labor market slack over the past year has led to a moderation in wage growth. After peaking at 7% in March of 2022, growth has continued to slow back to trend. Wages for private production and non-supervisory workers rose 3.9% year over year in November, putting them back in line with the 50-year average. While slower immigration would likely put upward pressure on wage growth, sustained strong productivity gains could help limit any pass-through of that inflation. S&P 500 earnings are expected to grow by about 9% in 2024. Analysts are projecting even stronger growth of 15% and 13% in 2025. Respectively, compared to the long-term average of 7.5%, these estimates seem a bit too rosy, particularly given our expectation for slowing nominal growth. Normalizing GDP growth could limit revenue growth, and slowing inflation could pressure margins. Nevertheless, trend-like nominal GDP growth combined with more stimulative fiscal policy should support solid earnings gains, especially when these gains broaden to beyond the largest stocks. Notably, while earnings of the Magnificent Seven companies grew by 31% in 2023 and 36% in 2024, earnings for the rest of the S&P 500 contracted by 4% in 2023 and then grew by just 3% last year. 2025 should finally bring the much anticipated broadening. The Mag 7 earnings per share growth is expected to decelerate to a still strong 21%, while earnings per share growth for the rest accelerates to 13%. Similarly, by first quarter of 2025, analysts are projecting positive earnings per share growth for 10 out of the 11 sectors compared to just 4 out of the 11 in the first quarter of 2023. As lower interest rates awaken U.S. manufacturing activity, we think a cyclical recovery could drive the next phase of the broadening. With this greater earnings breadth should come greater market breadth. 2025 leadership should be less narrow, reducing the risk of elevated concentration in valuations and increasing opportunities for active investors. Inflation made meaningful progress towards the Federal Reserve's 2% target in 2024, allowing the Fed to kick off its rate-cutting cycle. That said, downward momentum waned in the fourth quarter, sparking fears that progress on inflation had stalled. Indeed, headline Consumer Price Index (CPI) rose 2.7% year over year in November, compared to just 2.4% the previous 2 months. However, recent gains are largely due to base effects, with little evidence that price pressures are building. Inflation should resume downward march in 2025. For much of last year, core goods prices had been a steady source of deflation as supply chains remained well managed, even with elevated geopolitical tensions. In recent months, however, prices have moved higher on a sequential basis, largely due to rising vehicle prices. That said, auto inventory to sales ratios have trended higher off the post-pandemic lows, suggesting pressure here should fade. On the more volatile components, lower gasoline prices have weighed on energy prices, while food inflation has remained mild. Moving forward, sluggish global demand limits the likelihood of a surge in either of these categories. That brings us to the key drivers of inflation: shelter and auto insurance. Shelter inflation accounts for over a third of the CPI basket and has held stubbornly above its pre-pandemic trend. That said, real-time measures of markets rent to a more normal level of shelter inflation ahead. Auto insurance, a consistent hotspot for inflation, eased slightly in November, but still is rising by 13% year over year. Fortunately, as the rollover in vehicle prices feeds through the data, this trend should continue lower as well. Overall, inflation should continue to ease in 2025. Price gains in shelter and auto insurance remain elevated, although real-time data continue to point to easing pricing pressures ahead. However, policies discussed by the incoming administration, should they be implemented as communicated, could cause progress on inflation to reverse course, at least temporarily. Over time, economic globalization has led to increasingly relaxed trade policies. Indeed, the average tariff rate on U.S. goods imports has steadily fallen since the 1930s. However, geopolitical tensions and supply chain snarls induced by the COVID-19 have prompted a reevaluation of open trade policies. With promises to protect American businesses and address unfair trade practices, tariffs sit in the center of the Trump administration's policy agenda. Page 31 of the guide helps put recent tariff proposals into context. Assuming a 20% universal tariff and an additional tariff on Chinese imports of at least 60%, calculations by the Tax Foundation suggested that average tariff rate on U.S. imports could rise by 17.7% in 2025, up from 2.4% in 2023. Admittedly, U.S. trade policy remains highly uncertain, and it is unclear whether trade policies will be implemented as proposed. Moreover, it's unclear whether they will be implemented permanently or used primarily as a negotiation tool. Regardless, tariffs are likely to rise under the incoming administration, with a particular focus on China. Beyond discouraging imports, tariffs can have negative unintended consequences. If enacted as stated, tariffs could lead to higher inflation and trigger retaliation, reducing the demand for U.S. exports. Overall, aggressive tariffs would add even more uncertainty to an already foggy economic outlook, complicating the path forward for the Federal Reserve. The labor market has normalized from its post-pandemic boom, but looking through recent distortions from strikes and hurricanes, job growth has settled into a relatively healthy pace. That said, the Trump administration has expressed its intent to take a tougher stance on immigration, which could have meaningful impacts on the labor market in 2025 and beyond. After falling sharply during the pandemic, labor supply in the U.S. staged an impressive recovery over the last 2 years, largely due to increased immigration. In fact, CBO, the Congressional Budget Office, estimates suggests that immigration accounted for over 80% of total population growth in recent years. Moreover, in fiscal year 2023, Immigration Services approved over 2 million initial applications for employment authorization, a 70% increase from a record 1.2 million in fiscal year 2022. With the surge in migrant population and workers, employers were able to fill open job openings without applying upward pressure to wages, helping to explain why strong job creation hasn't sparked higher inflation. However, if immigration were to be significantly restricted, it could hinder labor force growth, especially given weak domestic demographics in the U.S., and potentially lead to higher inflation through higher wages. A strong recovery in the labor force participation rate has also boosted labor supply, while the continued aging of baby boomers into their retirement years have left overall labor force participants below pre-pandemic levels. Participation among prime age workers has fully recovered its pandemic losses and has been particularly strong among females. Moving forward, steady economic growth and solid corporate profits should support a moderate pace of hiring. However, severely curtailed immigration could provide a stagflationary impulse, potentially weighing on economic growth while exerting upward pressure on inflation via higher wages. Among other expansionary fiscal policies, the Trump administration has expressed its intent to fully extend the Tax Cut and Jobs Act, or the TCJA, and reduce the corporate tax rate. At the same time, it has promised to dramatically cut costs. In determining whether these two policy proposals are feasible and how they could impact the fiscal health of the U.S., page 22 of the guide has been particularly useful. The left chart shows the CBO, the Congressional Budget Office, estimates for government spending and how that spending will be financed in fiscal year 2025. To reach its total cost-cutting goals, the incoming administration would have to make some difficult decisions. Non-defense discretionary spending accounts for just 12% of the government's budget, meaning that they have to explore spending cuts on defense or entitlements. The administration has also expressed its intent to use tariff revenue to offset the extension of the Tax Cut and Jobs Act. However, tariffs are only a sliver of current government revenues, and that will likely remain the case even if Trump tariff policies are implemented in full. Moreover, higher tariffs by inviting retaliatory tariffs would slow the economy, reducing revenues from other areas of income taxation. On the right, we explore the outlook for the deficit and federal debt. With no revenue or spending offsets, the Tax Cut and Jobs Act is likely to amount to a significant stimulus and add to the deficits. Every year, the federal deficit gets added to the overall debt, which we show on the bottom right. According to the Congressional Budget Office, federal debt is expected to climb to nearly 120% of GDP by 2034, excluding the impacts of the Tax Cut and Jobs Act extension, and nearly 130% with them. That is up from 98.2% in fiscal year 2024. Other sources, such as the Committee for Responsible Budget, believe that a full implementation of President-elect Trump's proposal could boost the debt by a whopping 143% of GDP by fiscal year 2035. Since the Tax Cut and Jobs Act extension and additional provisions will need to be passed through a once-a-year budget reconciliation process. They are unlikely to go into effect until early 2026. And after that, expansionary fiscal policy will not only boost deficits, but could also act as a longer-term source of inflationary pressure. So the new administration certainly has their work cut out for them to get growth above some of these extra spending levels and reduce tax cuts. And previously, the CBO, the Congressional Budget Office, do these expectations on very static straight line assumptions. The reality is sometimes these tax cuts do boost growth, which increases revenue, which is the case previously with the Tax Cut and Jobs Act. So some of these more stagnant assumptions prove to not be as accurate as the reality. With inflation trending lower and the labor market softening, the Federal Reserve, attentive to both sides of its dual mandate, cut interest rates by 100 basis points in 2024. In 2025, the committee will certainly have a preference to continue easing policy until it reaches a neutral stance. However, fiscal stimulus, in addition to tariff and immigration policies, if passed, could make this difficult to achieve. At its final meeting of the year, the Federal Reserve voted to cut rates by 25 basis points, which is 0.25%, reducing the Fed funds rate to a range of 4.25 to 4.5. This move was largely expected, and investors found themselves more focused on the press conference and the latest set of economic projections. In his comments, Federal Chair Jerome Powell noted that he is optimistic about the health of the economy and that the downside risks to the labor market have largely diminished. He also noted that inflation, while still moving in the right direction, has been hotter than expected in the recent months. These views were reflected in the summary of economic projections, which showed a higher growth forecast and lower unemployment forecast for 2025, as well as higher inflation forecasts for 25 and 2026. With solid economic activity and increased inflation uncertainty, the committee penciled in just 2 rate cuts in 2025 versus 4 in the September assumptions. In acknowledgement that the economy be less interest rate sensitive, the neutral federal funds rate ticked higher to 3%. Today, market expectations remain more hawkish than the Fed's forecast, highlighting investors' fear that inflationary policies proposed by the incoming administration might force the Fed to consider a slower pace of policy normalization or pause that altogether. We agree that a more gradual policy easing path is the most likely outcome, limiting any downside moves in interest rates. However, until we gain more clarity on President-elect Trump's policy agenda, the pace of rate cuts will continue to hinge on the incoming economic data. Investment grade and high yield corporate credit bonds finishing the year up over 3% and 8% respectively. While this rally has left corporate credit looking expensive, we continue to find opportunities across this asset class. On slide 37 of the guide, we show corporate credit spreads over time and compare current spreads and yields to their long-term averages. Across both investment grade and high yield, spreads are sitting near all-time highs as strong earnings growth subdued. Default activity and improved credit quality have biased near narrower spreads as well. While valuations in both sectors look expensive and credit investors are unlikely to generate meaningful gains from narrowing spreads, investors should embrace credit for the all-attractive all-in yields. Investors can take comfort in the fact that the widening spreads shouldn't be an issue in 2025 either, as a benign economic backdrop and broadening earnings growth should keep them tight. With the Fed likely to ease policy only gradually, it's difficult to make any outsized duration right now, meaning if you should be in longer-term bonds or shorter-term bonds. For those searching for enhanced yield and higher returns, corporate credit offers an attractive opportunity. That said, not all bonds are created equal. An active approach to fixed income investing will likely be attractive in finding opportunities while balancing potential risks with higher returns and rates going forward. At over 22 times the S&P's next 12-month price to earnings ratio, the PE ratio, is close to the dot-com bubble peak, meaning the market's about as expensive or close to as expensive as it was during the dot-com bubble peak. While this doesn't tell us much about short-term returns, history shows that high valuations are correlated to lower long-term returns. Mega cap tech is getting a lot to the blame. Indeed, the 10 largest stocks have a forward price to earnings ratio or PE ratio of over 30 times, roughly 150% of the long-term average. This is especially concerning as these top 10 stocks have now constituted almost 40% of the stocks market's value. Valuations for the remaining stocks in the S&P are also elevated, but less so, with a forward PE under 120% of their long-term average. This might be a good place to start hunting for some less appreciated opportunities. Though elevated index level valuations might give investors pause, dispersion suggests that there are opportunities underneath the hood. The difference in valuation between the 100 most expensive stocks and the 100 least expensive stocks is currently wider than it has been 90% of the time over the last 28 years. So odds are there are a lot of stocks with price tags that are too high and a lot of stocks with price tags that are too low. While this could cause elevated volatility at the index level, it should also create opportunities for active stock pickers, especially as earning breadth increases. As US stocks have enjoyed an extended run of stellar performance, international stocks have long been the underdog. That said, 2025 could be their time to shine. Not only have strong US equity performance pushed valuations to lofty levels, but the US now also makes up 65% of the global stock index, despite accounting for only 25% of the global GDP. This suggests that the US stocks are pricey and it might be wise for investors to consider diversifying into other global markets. Another interesting fact is the US is about, 4% of the global population, which is cool. We account for 25% of the global GDP and 65% of the global stock market. While many international markets are facing cyclical challenges, structural tailwinds should continue to drive strong performance in select regions. Japan, for instance, is moving out of a long period of deflation, stagnant normal nominal growth, and negative interest rates. Reflation in the country should support consumer spending and domestic earnings growth. Moreover, corporate governance reforms should continue to support flows from that region. While China's path ahead may be bumpy and involve trade conflicts with the US, opportunities in emerging markets, excluding China, have been promising. Taiwan outperformed the US in 2023 and 2024 due to its strong ties to the tech sector and AI tailwinds and should continue to benefit from the tech cycle boom in 2025. Robust earnings and services exports growth have supported strong performance in India as well. While elevated valuations leave the market susceptible to a pullback, the region's long-term investment case remains compelling. As seen on page 43, performance across countries has varied. By using an active approach to find the most compelling stories, investors can allocate abroad without having to compromise on performance. For investors overexposed to the US, it might be prudent to take some profits and diversify across other regions. Historically, international equities have traded at a discount to the US due to their value tilt, lower liquidity, and economic and currency risk. However, the current discount appears larger than warranted by these factors. As both stocks and bonds rallied in 2024, the challenges facing the traditional 60-40 portfolio, which is 60% stocks, 40% bonds, kind of your more moderate portfolio, that became even more pronounced. Stocks and bonds remain positively correlated and continue to offer mediocre levels of income. Moreover, elevated equity valuations and lower bond yields relative to history point to a less impressive return for the 60-40 portfolio moving forward. Against this backdrop, investors may look elsewhere for consistent outcomes across alpha, income, and diversification. Investors wanting to venture outside of the public markets can leverage a range of different alternative assets that reach their desired outcomes. Indeed, as we show on slide 56 of the guide, alternative assets can offer lower correlation to the public markets, more diversified income streams, and enhanced long-term returns. Real assets, as shown towards the left, such as real estate, infrastructure, and transport, tend to be less correlated, meaning less moving in line 60%, 40% stock to bond portfolio, while providing robust income. Private equity and venture capital toward the right could provide much higher total returns, but come with higher correlations to public markets and less income generation. Classic 60-40 stock bond portfolio still looks attractive, but adding a sleeve of alternatives can help boost long-term investors' goals and improve their diversification and enhance their income. So we thank you all for joining us today. Certainly reach out if you have additional questions on any of these key slides of the guides of the markets, or as any of these themes would impact your retirement needs or goals or your investment portfolio. Thanks you all so much for joining us today. We wish you a great rest of the week and certainly contact us if we can be of assistance to help you preserve and grow your family's wealth.